It's really important. Every business, whether you're bootstrapped, you're funded, you're needs funding to make it all work, right? And one really cool new way of funding is called crowdfunding. George's gonna tell us all about it in a moment. But what's so cool about this is that it is changing. It's something for companies that a lot of people have not heard about, or if they have heard about it, they may not have all of the information. And so when we were putting this together, we were just so thrilled that George is willing to come and talk to us, because we're like, finally somebody can help us really like get to the bottom of this, can help us really like just get into it. So on that note, George Cook from Honeycomb Credit, thank you so much for being here. Please take us away.
Awesome. Benny, thank you so much for having me, and really excited to be here. So I'll kick it off with just a couple of slides to talk a little bit about crowdfunding and make sure we're all speaking the same language and we kind of understand at a high level what crowdfunding is. And then from there, we'll open the floor and see what questions the group has. So to jump right in, a little bit about my background. I am a 6th generation community banker. So my family has been running a small community bank in rural Appalachia for 130 years. I grew up in the family business, and I learned a lot about community capital and really what small businesses need in terms of access to capital. But I was pretty disheartened in my career to see that we're actually seeing a really major trend in the way community banks work. In fact, we're losing one community bank every day in the United States. And it shouldn't be surprising that when the primary lenders to small businesses are going away, so too is access to capital. And filling that gap left behind are a whole lot of online lenders. There's startups like Lendio and Fundbox, but there's also big Silicon Valley incumbents like Square, and now even Amazon. Amazon's actually one of the largest small business lenders in the country now. About 1 in 3 small business loans in the United States are coming from these online lenders. They're growing like crazy, but unfortunately, they are charging just ridiculously high interest rates. A study from the Opportunity Fund came out a couple of years ago and found the average interest rate for these lenders is 94%, to give you a little bit of context. So we know that debt isn't perfect for everyone, but we also know that debt's now harder and more expensive to get access to for younger small businesses. But the story for venture capital isn't a whole lot different. If you look at the distribution of venture capital across the United States, and this is from the Brookings Institute, we found that they find that over 50% of venture capital is concentrated in California, much more of it concentrated in the Northeast. And for folks like us in the Midwest, the access to capital through venture capital is just not there. So with that context in mind, with the idea that not all types of capital are created equal, and not everyone is able to get access to capital, there's some really interesting trends going on with crowdfunding and crowdfunding for small businesses in particular. And it should be noted that crowdfunding over the internet is a relatively new phenomenon. But crowdfunding itself has actually been around for hundreds, if not thousands of years. The base of the Statue of Liberty in New York was actually crowdfunded by everyday people who mailed in $1 coins to fund the base that you could actually put the Statue of Liberty on once it was gifted to the United States. And that sort of represents this community spirit of crowdfunding, the idea that you can take small amounts of money from many people to fund a much larger project. And in this case, it's funding a small business's project. And there's several really key different types of crowdfunding. So crowdfunding is roughly broken up into rewards or donation crowdfunding or investment crowdfunding. So rewards or donation can really run the gamut from donation for maybe a business that's recovering from a disaster or looking for charity for some extreme circumstance. Rewards are often for businesses that maybe have a product that are pre-product or pre-revenue, They want to offer something in exchange, but they just don't have anything to offer quite yet. And then investment crowdfunding can range from equity crowdfunding, where you're actually selling a piece of your business to the crowd, or debt crowdfunding, where you're borrowing a loan that otherwise kind of looks like a bank loan, but instead of borrowing from a big bank, you're borrowing it from your customers and fans instead. So in terms of some of the large platforms, some of the reward and donation crowdfunding platforms you probably have heard of, they've been around the longest, they're the most well established. You have Kickstarter, you have Indiegogo, you have GoFundMe. On the equity crowdfunding side, and I should point out within the whole world of investment crowdfunding is the newest version of crowdfunding. In fact, in the United States, investment crowdfunding was not legal until regulation crowdfunding as part of the Jobs Act was finalized back in 2016. So investment crowdfunding is less than 5 years old. And so it's still fairly nascent, still growing very, very quickly. And people are still kind of finding different flavors of it and still defining what investment crowdfunding is going to look like. Some of the bigger players on the equity crowdfunding side are WeFunder and Start Engine. Republic is also a very popular platform, and Seed Invest as well. And then on the debt crowdfunding side, the debt crowdfunding is even younger than equity crowdfunding. Honeycomb in particular is focused on debt crowdfunding. And then Kiva, who's a large nonprofit lender. They operate in many different countries, but they also have a small US arm that does loan crowdfunding as well. So to give you some tangible examples of what these different types of crowdfunding look like, I'll kind of step through each and give you kind of one practical example of the types of businesses that tend to do really well with these different types of crowdfunding. So reward and donation crowdfunding, again, Kickstarter, GoFundMe, and Indiegogo are the three largest players here. The requirements to launch a campaign are fairly minimal. Most of the platforms do require that you have a good plan, a business plan of what you're going to use the funds for. Most of them will require a nice video. The average raise on Kickstarter most recently was just about $20,000, but it really runs the gamut. There are businesses that raise a couple of $1,000s. And here I have an example of Pebble, the smartwatch company, that raised more than $10 million. So it can range from very small campaigns to extremely large campaigns and can really run the gamut. The ideal customer, the ideal business to be running a reward or a donation crowdfunding campaign. On the reward side, the businesses that we see that are most successful are businesses that are pre-launch and they're product companies. So Pebble, again, is a great example. They came and did a crowdfunding campaign before the product was ready. They went and used crowdfunding both as a tool to market their new product, also a tool to raise money to build the new product, but probably most importantly, to validate that they should spend all of this money on production. They were able to, before they spend a nickel on making their product, they were able to let the people, let the community, let the crowd tell them that people were interested and were going to buy the product once they launched it. And then on the on the donation crowdfunding side, we often see businesses that, small businesses that maybe were impacted by a natural disaster or for whatever reason are having a trouble or hitting some sort of trouble, will use donation crowdfunding like a GoFundMe to help stabilize the business. In terms of the cost of reward crowdfunding in particular, most sites are going to charge between 8 and 10% of what you raise on the platform. And increasingly, a lot of crowdfunding platforms are requiring that you carve out a marketing budget for the campaign. So the expectation, especially if you're thinking about raising a $10 million crowdfunding campaign, the expectation is that you're going to spend tens, maybe even hundreds of thousands of dollars in digital marketing to get people interested in the campaign. This is especially true for companies that are pre-launch, that might not have that existing community yet. For businesses that are already around, that already have some social media presence, that already have an email list, you can lean into those existing channels instead of having to leverage raw marketing spend to bring people to the campaign. The second type of crowdfunding is equity crowdfunding. Equity crowdfunding, the requirements are now much higher. These are registered. All of these crowdfunding campaigns are registered with Securities and Exchange Commission and FINRA, and so there's certain requirements that a business must have in order to run a campaign. To give you a sense, you're going to need detailed financials for the past couple of years if you've been in operation. You're going to need a really detailed business plan. You're going to need a really detailed sources of funds and uses of funds that you're going to take the money for, and what you're going to spend it on. And kind of the ideal customer, therefore, is a little bit more sophisticated. It's someone who is revenue generating. And for these equity crowdfunding campaigns, it is typically very high growth, very high tech startups. So businesses that are likely to have a liquidity event in the future. They're going to someday go an IPO on the stock exchange, or maybe they're going to sell to another tech company. But these are companies that are going to grow very, very quickly and ultimately exit. They're going to sell their company to someone else. Similarly, the cost for crowdfunding itself is going to be somewhere between 8 and 10% of the amount you're raising. Plus, again, equity crowdfunding platforms like WeFunder are increasingly requiring you to have a very large marketing budget for your campaign. And keep in mind, you are giving up equity in your business. You are selling a slice of your business to the crowd. So if your business grows 10x, if your valuation is $1 million and you grow your business to $10 million and you sold 10% of it, all of a sudden you have sold $1 million. You've given away $1 million of equity to raise $100,000. So keep that in mind. It can be very, very expensive if you take on equity at the wrong time. It can be a great tool to grow the business, but can be very expensive. And finally, loan crowdfunding. So this is where Honeycomb is in the market. Very similar requirements to equity crowdfunding. You're going to need to have those detailed financials. You're going to need to have a business plan. The same SEC and FINRA requirements go into a debt crowdfunding campaign. The average raise on debt crowdfunding is typically a little bit lower. On Honeycomb, we range from $50,000 to $250,000. Kiva offers much smaller loans, generally from $5,000 to $10,000. The ideal customer here is now someone who has a steady cash flow, who can pay a monthly debt payment, who is revenue generating, and has nice stable growth. Maybe not going to the moon, maybe not that exponential hockey stick growth you hear about sometimes, but a nice steady growing business that can service debt. The cost is going to be that 6 to 8. The cost is a little bit lower in terms of the amount raised, typically 6 to 8%. But then keep in mind, there's also an interest rate you'll be paying back on this money as well. And one example of businesses that we worked with, so Harvey Farms is a Honeycomb alumni. They raised $235,000 with us. They're a farm delivery service. So they work with local farmers and source a customized CSA where you can log in every week and get local produce delivered to your home across several different states where they're operating. So that's just a little bit of context, kind of setting the stage, making sure everyone is aware of crowdfunding and excited to kind of jump into a conversation. But I'd be remiss if I didn't invite all of you to check out honeycombcredit.com and learn a little bit more about crowdfunding by checking out our site as well. I'm going to bring Benny back onto the stage here. All right.
Good to be back. And oh yeah, that was really interesting. I know I feel like when I first did the research, yeah, like the loaning and they just weren't out there at all, and so that's really cool to be kind of on the forefront of that. And so I appreciate that. So I know, yeah, we're gonna have a lot of time here to take questions from the audience. And I'm gonna pull up one or two of my own as we get rolling here. But just as a heads up for everyone, and just another reminder, if you have any questions that you want to put in and have us talk about, put them in the room chat on the right side of the screen, and we will make sure to get to them. So, okay, so I know my first question that I have is kind of revolves around something I've heard that I think is a myth, and I want you to kind of go into it with us a little bit. And that story is that crowdfunding may be kind of for lemons, right? That crowdfunding may be for companies that would not be able to get venture capital funding, or other things. And it's true there might be a lot to unpack there, but if you don't mind, please address that. What do you think?
Yeah, it's a really good point. And I think in the early days there was some of that. I think there was this idea that, I couldn't go out and get angel investment, I couldn't go out and get venture capital investment, or in our case, I couldn't go and get a bank loan. But I think there's a couple of really important points. One is venture capitalists don't know everything. Banks don't know everything, and they make mistakes. They leave a lot of really good businesses underbanked or underinvested, and it's especially true for women-owned businesses, for minority-owned businesses. That's especially true for businesses in the Midwest like us. And so I think on one side, I always take that with a little bit of a grain of salt, because it assumes that the financiers are smarter than the crowd, and I don't think that that's always true. Secondly, I think there's also um, the stage at which businesses are typically crowdfunding, because there were limits up until very recently. The maximum amount that a business could raise was $1 million, and a lot of funding rounds for businesses at the Series A, Series B, Series C can be 5, 10, 20, $50 million. And so the ability to go out and raise $1 million in crowdfunding was relatively unattractive, because there were much larger pieces of financing coming together. And so it was kind of a drop in the bucket. And so a lot of businesses didn't even turn to crowdfunding because it wasn't really a viable option for them. And frankly, a lot of venture capitalists were kind of discouraging businesses from doing crowdfunding side by side with a venture capital raise, because venture capitalists are kind of scared of crowdfunding. And so I think all of that has really started to change in the past 18 months or so. Some of the regulations have eased, so you can actually now do larger raises of up to $5 million, so much more meaningful amount of money. And simultaneously, I think venture capitalists are starting to realize, angel investors, venture capitalists, even banks are starting to realize that there's some really interesting benefits to crowdfunding. That if a business can go out and get their customers to invest in them, those customers are going to shop at the business more often. They're going to tell their friends. They're going to really engage on a much deeper level. And so what we're actually starting to see now is crowdfunding side by side with more traditional funding. So whether that's someone on kind of the debt track that's getting a bank loan side by side with a loan crowdfunding campaign, or someone that's going out and raising a $10 million Series A, and they're saying, you know what, we're going to take, of that $10 million, we're going to take 2 million of it, and we're going to give it to our customers instead of giving it to some big fund in Silicon Valley. And that we're seeing more and more often. And so we're bringing more businesses and higher quality businesses and startups into crowdfunding. And I think the reputation of crowdfunding is just going to continue to improve over time.
Yeah. It's cool you touched on something at the end there that was another question of mine. It's kind of like, why don't we see big tech companies doing this? Or why don't we see, the Airbnbs doing this kind of stuff? And maybe if you want to address that, because I think you touched on it, but yeah, like, where is it? Where are they doing it?
Yeah, it's interesting, because businesses, the startups that we often hear about, Uber and Lyft and Airbnb, the startups we interact with on a day-to-day basis, most of us, are not really startups anymore. If you're a household name, chances are you have raised hundreds of millions of dollars in venture capital. And so it's really hard for those types of businesses to go and say, yeah, we're going to raise $1 million, or we're going to raise $5 million on crowdfunding on the side. But that said, I mean, Robinhood crowdfunded in their early days. Zenefits crowdfunded in their early days. Gumroad, a really cool kind of a marketplace for talent. They were the first company to go out and raise a $5 million campaign when the regulations changed, and they did it in 36 hours. So there are increasingly household names that are using crowdfunding. But I think more importantly, what we're seeing is businesses that crowdfunded in the past are growing to become household names, which I think proves that the quality of some of these earlier stage startups that are crowdfunding is proving to be very high, and they're proving that they've got what it takes to grow and evolve and become the household name.
I see that. I think that makes sense. And it's true that, even as you were talking, it's like, oh yeah, I know these companies. You know what I mean? Like I'm familiar with them. So it's almost like they are, it's in a lot of ways. And so I've got one more that I wanted to make sure to cover. And we'll really curious to hear from you guys in the crowd what questions you have. I know we all already got one or two. So, but the last one I kind of have is kind of about stakeholders to listen to. So I think when small business owners and entrepreneurs, when they're like, all right, I know I really want to get funding, to enable me to do this. Sometimes there's this voice of like, are you going to get to be your own boss anymore? Like, who do you have to listen to, kind of thing. And with crowdfunding, where, my perception would be you've got a lot of people that are investing, because it's the crowd. Does that make it difficult to kind of listen to a bunch of stakeholders, or how does that dynamic play out?
Yeah, it's interesting. So maybe I'll address it first from kind of the debt side and what we see. And so what we're finding is whenever someone is lending money on Honeycomb to a small business, there's no direct ownership, right? In no way are you giving up any right to control the business the way you want to control it. And it's actually been the exact opposite. We never hear businesses complain about, oh, that guy invested $1,000 and he came into my shop and told me to rearrange my furniture and wanted me to change my menu. We never hear that. But instead, what we do hear is that, oh, someone invested $1,000. They came into the store, introduced themselves. Turns out they're a CPA and they agreed to do my books at 50% discount because they love my shop so much. Or like, oh, I had someone invest in my business, and it turns out they run their own business and they want to collaborate. And so we hear that all the time, that there's these really interesting synergies that happen whenever you bring more people into the fold who want to help you, who are emotionally and financially invested in your success. They're going to find creative ways to be helpful. And for the most part, they're not going to try and stand in your way and control how you run your business. And we've heard pretty similar things from the equity crowdfunding platforms. It's also pretty important to note that most of the equity crowdfunding platforms you're not investing directly into the business. You're investing through what's called a special purpose vehicle. So instead of, let's say you raise $1 million and the average investor was $1,000, you don't have 1,000 different people listed out on your capitalization table. Instead, you're going to have one line that says my WeFunder investors, if you use WeFunder. And you could click on that and you can see who those 1,000 people are. But it's not like all of a sudden you have 1,000 new owners of your business that you need to listen to. It's really kind of one line item. And each of those investors is relatively small. And they very well might shop at the business more. They very well might post on social about you. They very well might help your business grow. But in all likelihood, they're not going to be sending you, the CEO, emails telling you, what new product feature you need to build because they're cranky.
Yeah, and that's like a breath of fresh air, just kind of, especially because it makes sense. It makes sense that, if you give somebody the ability to choose to be a part of the company and to really be, have the agency to help, that they're going to go beyond and they're going to be advocates, and I can see how that really helps for that brand identity and for that marketing at times. And so thank you for clarifying that. So to turn to the chat and some of the questions we've got, someone got us a really good one from Maximilian. He's asking, are there any key regulations that people should think about as they're pursuing crowdfunding?
Yeah, absolutely. So there's several regulatory frameworks. I should note that reward and donation crowdfunding, the Kickstarter and Indiegogo's we talked about, those are unregulated platforms. So there's no regulatory framework there. There's really no recourse if you are an artist and you say you're going to go out and film a movie and you're going to give everyone a copy of the movie, as you see on Indiegogo sometimes, there's really no legal obligation for you to do that. It's kind of a jerk move if you don't. It's not great. People don't like giving you money and not getting the thing back in return. But there's not a whole lot of accountability in those reward crowdfunding platforms. On the other hand, with the investment crowdfunding platforms, the debt and equity crowdfunding platforms I have spoken about, both of them operate under what's called regulation crowdfunding. And regulation crowdfunding was part of the big bipartisan Jobs Act, which passed back in 2012. It took the bureaucracy a few years to finalize those rules and actually lay them out. And so the rules were finalized in 2016. And so when a business is doing a regulation crowdfunding campaign, so in the eyes of an equity in the eyes of the government, in terms of an equity crowdfunding campaign, you're going out and selling shares of your business. It's almost like a mini IPO. It's certainly not an IPO, and the long-term requirements are very different. But there are requirements about the information you disclose to your investors when you go out and make that offering. And then there are some periodic requirements about information that you're going to provide. So one thing to keep in mind is that if you're going to run an investment crowdfunding campaign, you're obligated to share at a very high level, but share your business's financials, and to follow up with folks a year out or even a couple of years out with how the business is progressing, because they're stakeholders in the business. And some businesses are very sensitive about that. I think some are very open and willing to communicate that, but that is something to keep in mind. Most of the platforms will help you with all the regulatory filings. So as an example, we have a dedicated customer success team that helps our businesses build their campaign page, to fill out what's called a Form C. That Form C is basically an investment prospectus that then goes on to the SEC and can be publicly downloaded. And we help the businesses create all of that. They're obviously responsible for all of the information in those documents, but we know how to navigate the regulatory environment. We know how to kind of structure those documents in a way that the SEC is looking for. And most of the platforms will help guide you through that process.
Yeah. As entrepreneurs, that it's always a question that, you want to be able to just run with your passion and run with the mission, but you got to know, knowing that, even beyond kind of like the making it easy, but the we've got your back here, not only are we going to make it easy for you, but you're almost kind of acting like a lawyer, in some ways. And you're almost saying hey, we're experts here. We're going to, just built into the platform and everything. So it's really cool to hear. Another question we have from Ross about collateral and obligation. So he asks, how does collateral and obligation to repay work for different crowdfunding methods? So Kickstarter had some high profile projects that disappeared without producing the promised products. I think you touched on, how the legal obligations, but how does that collateral and obligation work?
Yeah. So again, with reward and rewarding gift crowdfunding, there is really no requirements, no legal structure to that. And so if you're pre-selling a product, people have an expectation they're going to get that product, and they might be pretty sour if they don't. But there's really no recourse that the business is subject to through the contract that they have with their donors, or the contract that they have with Indiegogo or Kickstarter. So, in terms of kind of building long-term faith from their customers and building engagement, not a good look to not fulfill those obligations, but there's very little kind of negative recourse. On the equity side, you are actually selling a piece of your business. So these are now people that own a piece of your business. And if you sell the business, they will come along on that journey with you, and they're going to earn the same amount proportionately as you are. If the business goes south, and the business is liquidated, they will have some rights to the funds that are liquidated. On the debt side, very similarly, this is a legal agreement between you and your investors. Most of the deals on the Honeycomb platform, as an example, do include collateral coverage. So if you're buying a food truck with your Honeycomb campaign, we'll oftentimes take collateral on that food truck. And oftentimes we also have personal guarantees from the owners. Now, all of that said, even though there is kind of this rigid legal structure, we found that investors, the lenders, are very favorably inclined to be supportive to these small businesses. So, as an example, we had a restaurant customer who was struggling during the pandemic, and they went out to their investors and they said, "Hey, investors, is it okay if we go interest only for a few months while we get back up on our feet?" And we had a voting process, and virtually every investor voted yes and said, "That's fine. Do what you got to do. Make sure the restaurant survives." And now they're back on full repayments and they're doing great. And that's just kind of an example that this is a legal financial obligation you're taking on when you talk about investment crowdfunding, but these are also your biggest fans and they want to see you succeed.
Yeah, that's awesome. And that's kind of a good story, with the pandemic and all these different ways we support each other as a community. It's cool to hear that, yeah, crowdfunding too, like we all stepped up and, we all kind of experienced that love and that support. And to the example with the restaurant, this is a question of my own. What kind of businesses and maybe like are really great for crowdfunding, or perhaps maybe like that you see a lot, a large proportion, or just patterns in the types of businesses that, yeah, like tell me about that. Like, what is a good example of a business that should take a look at it, should consider it?
Yeah, I think kind of one of the core ideas is that direct to consumer businesses tend to do better in crowdfunding, any type of crowdfunding. If you're talking about Pebble watches that they're putting stuff on actual consumers' wrists. If you talk about a restaurant, people are showing up and ordering food and sitting down and engaging with that business. If you're talking about some of these tech companies, they have many customers. Robinhood, we talked about earlier, they have a huge customer base. And so they have a direct end customer who engages with their brand, who knows their business. And that's important because if you're a B2B SaaS company, if you're doing enterprise software, you might be doing really cool things. You might be doing really impactful things. But if you're just selling to IBM, Microsoft, and Citrix, it's going to be hard to get the crowd, to get the broad market really excited about what your business is doing. We've seen exceptions. There's some great exceptions to that. But generally speaking, I think kind of the first and foremost businesses that are most successful have that direct to consumer presence, and they've established their brand. They've figured out how to engage with their end customer, whether that's email channels or social channels. However, they have those engagements with their end customer. It's very expensive to acquire all of your contributors for a crowdfunding campaign. If you're just going to go and try to do it all through Google Ads, it's going to be a very expensive campaign, and the amount of capital you're going to raise, a lot of it's going to go to the marketing of that campaign, and there's also no guarantees it's going to work. But if you already have a robust customer base of people you can reach out to, people that are going to get really excited about being part of your growth journey, then you're just going to level those customers up, and they're going to spread the message for you, and they're going to bring more contributors to the campaign on your behalf.
Yeah, I see that. So I know I've got one more question that I'm really curious about. We will, maybe in about 10 minutes here, we'll take a break for networking. But so if you guys have any other questions, anybody in the audience, whether it's something that we talked about that you just want to dive deeper on, or maybe something we didn't talk about, or something about your business and about what you're building, please feel free to send it in the room chat. We would love to hear it. And I know, so kind of, my last little question here, I know we've kind of touched on it a little bit, but it's kind of like, how do you do it? And I mean, I know, like, because we've seen these sites and I've spent time on your website. It's very well done. But like, so if I am a business owner, if I have a restaurant, I have this, and I'm like, all right, that's it, George, sign me up. You know what I mean? Like, I'm ready to do this. Like, what should be that game plan? What does that look like?
Yeah. So first and foremost, it's building the plan and building the campaign page, right? So the campaign page is where you're going to tell your story. And we want to tell a really authentic story, right? Every small business has a unique journey. Every startup has a unique journey. It's just so inspiring to hear entrepreneurs talk about what they do and why they do it. And this is an opportunity to tell that story, to have this really authentic conversation with the end user. in a way that you can't just like tweet out on a Tuesday, right? It's just not how you engage with your customers on normally, right? You're talking about new features, you're talking about new specials you're doing, you're talking about promotions you might be offering, but it can be really challenging to find the right channel to tell people your backstory, to tell people your origin story, and more importantly, to share your vision of where you're trying to take your business. But your customers want to know that stuff. And so the campaign page is the perfect place to do that. So like with Honeycomb, we help you find a videographer. We kind of have some templates for the videos, really try to make sure the business owner is putting their best foot forward. We'll help the businesses put together the copy of the campaign page. There's some sections, usually a section around the background of the business, kind of what the project is about, where the business is headed. And for us, we also have a little section on what it means for the community itself. And then from there, we'll talk about, we like to think about kind of the concentric circles of crowdfunding is how we think about it. What we know is if a stranger lands on your campaign page and it's 0% funded, that stranger is pretty unlikely to engage and be the first investor, right? But if your power users or your grandma lands on that page, they very well might be the first user, right? They very well might be the first person to come in and say, yeah, heck yeah, I want to get this thing started. So it's really critical to identify who are those people that love you as an entrepreneur, who want to invest in you. They couldn't care if you were building a spaceship or bubblegum. They're going to support you because they are all about you. Then find the people that are really passionate about your product. Then find people who know who you are. And then you keep working out from that kernel, because the more momentum you can show in your campaign, the more excited the stranger's going to be when he lands on your campaign page. And so it's all about, kind of think about who that first concentric circle, the second concentric circle, third concentric circle, and then doing a kind of big, broad media push and a larger push of people who will just be excited about the momentum and the comments and the engagement they're seeing on the platform.
Yeah, I like that. Makes a lot of sense. I mean, I think, anytime you're sharing your message, there's kind of this level of, how do you make it kind of reverberate, make the waves kind of carry. And that's really insightful. And I can kind of tell through that you guys have helped a lot of companies do, that's very well thought out. And so thank you for that. And another question from the audience. This is from Holly. She's asking, in considering crowdfunding, what advice would you give for those business owners where it is about social impact or legacy, and not about the exit and selling the business?
Yeah, completely. So I think what we find, at least on our platform, is investors are on this spectrum between make money and social impact. And very rarely do we find someone that sits on either pole, right? Normally people are somewhere in the middle. And I would say generally they're probably in this quadrant of the social impact side. The people that, at least on the Honeycomb platform, are people that believe in small businesses, believe that startups and small businesses do good things for the community, and that are just really inspired by the stories of entrepreneurs and want to be a part of it. And so I think, compared to traditional angel investors or other types of investors, crowdfunding can actually be a really good place to find those kindred spirits who want to be part of the mission and the vision of what you're creating, as much as want a return on their investment. Now, of course, if they get a return, they're going to be really happy about that. That's gravy, right? But they want to go along on that ride with you, and they want to they want to understand what your impact is and be a part of that impact and help you spread the word.
Yeah, I like that. And because to that point, like it is another misconception where it's like, yeah, I mean, funding, it's a means to reach your goals, right? It's a means to fulfill your mission, and so I think that's a really good question, because it shows that, yeah, like it's not all about the exit and selling it at the end. You know, it's about doing what you're here on earth to do, you know, and what your company really believes in. And so it's cool to hear that the crowdfunding really is cohesive with that, you know, and really aligned with that. And that if you're chasing your passion, you guys are going to help, you know, there's really no kind of downside to putting it all out there on a crowdfunding platform like that. Great. So I know, and we're about to go here, and there's been a ton of really good takeaways from this. I know, as I've been taking notes, you know, even throughout, like, even though, because this is being recorded, by the way, for people, so I do not need to take notes. Do you have any final takeaways for the audience? You know, things that you really think should kind of reverberate, or that we should be sharing with other, you know, entrepreneurs in our community?
Yeah, I think we started this conversation with some of the misconceptions of crowdfunding, and I think a lot of that is just rooted in the idea that, one, it's a young space, and especially investment crowdfunding, it's just getting started and people are still figuring out what it is. And I think there's going to be some really cool applications of crowdfunding that emerge in the months and years ahead, and it's going to keep getting more exciting and more fun, and there's going to be different channels for different types of crowdfunding. But I think as an entrepreneur that might be thinking about crowdfunding, it's really important to understand the different types of crowdfunding and to make sure that you're finding the right platform for your business, right? If you are a big moonshot, high tech, high growth startup, debt's probably not the right option for you. If you've already got a product together and you're already generating revenue, you might be a little too mature to use reward crowdfunding. People might look at you and say, like, why are you digital panhandling? I've heard that term before, digital panhandling. Like, you're already generating revenue. That doesn't seem fair. Why would I give you $100 and you're going to give me a t-shirt, right? But if you can sell some equity in the company and get people to be owners, to be part of it, that might be the right fit for you. On the flip side, if you're pre-product, pre-revenue, and reward crowdfunding might be the right place for you. If you do have stable cash flow and are looking to take it to the next level, debt might be the right place for you. So just because there have been some bad stories of crowdfunding, I don't think, I think it's a sign of that, one, it's just new, and two, it's really important to find the right home for your crowdfunding campaign.
Yeah. Awesome. Well, this is incredibly insightful. I feel like we've packed a whole like semester of a college education into this. So George, thank you so much. I'm gonna, everybody behind your computer screens, give a big round of applause. Thank you so much for being here and for taking the time out of your day. We really appreciate it.